Australia's economic growth rate has slowed at the beginning of the year. Official data shows GDP grew by 0.3% in the first 3 months of the year compared to 0.8% in the previous quarter. That takes the annual economic growth rate to 2.5%, down from the December quarter reading of 2.6%. During the first quarter of this year, there were 2 RBA rate rises and the first month of the Iran-US conflict. So repeating that breaking news, the Australian economy has grown by 0.3% in the first 3 months of 2026, taking the annual growth rate down to 2.5% from 2.6%. The market consensus forecast was for the growth rate to hold steady at 2.6%. Now let's bring in AMP economist My Bui. My Bui, this was slightly below expectations, but it comes after some partial data yesterday, which had sort of started to lower expectations among economists.
Hi, Alicia. Totally. I think that the data today shows that the Australian economy has started to show some slowing impacts from rate hikes, but we were definitely starting from a very strong base. Remember that we had a bit of a drag from the rise in imports of equipments for data centers, which basically lowered the net exports figure. Meanwhile, the consumer spending data was still up by a very decent 0.5% over the quarter, and private business investment actually soared by 6% over the quarter after a long period of hovering around 0% quarter-on-quarter growth. So I wouldn't be too negative on today's data. There will be a lot more headwinds to come, but we were definitely starting from a rather okay base.
Yeah, and as you say, we're still growing. 0.3% is still growth. The economy is growing at 2.5% annually. But the investment in the data centres is quite interesting because it did detract from the net exports because there are a lot of imports coming in, but it also is showing up in demand. Can you run us through that story?
Yeah, so remember what GDP actually measures is gross domestic product. So it measures what Australia produces over the quarter. Remember that a lot of the equipments for data centers, we don't manufacture them here in Australia. That's why you have to take them out when you measure it in terms of expenditures over the quarter. So I would say that the detraction is more of an accounting quirk. It increases business investment, but it detracts from net exports. But over the long term, we think that this is actually a positive for GDP in Australia because overall, you still see that construction on non-residential investment, for example, people building data centers, that's still up over the quarters. Over the long term, that might actually create some other productivity enhancements or create other jobs as well. We just know that over the short term, there's a little bit of a minimal impact from those data center booms. It's not too big in terms of contribution to GDP.
Now, the headwinds from the conflict in the Middle East are only partly reflected in this quarter's numbers because it only goes up to the end of March.
Yeah, totally. I would say that the impact from the Middle East actually has opposite impact. So it actually didn't detract from activity this quarter. It actually added to household spending. Why is that? We actually saw quite a lot of increase in essential spending. I think it was up by 0.8% over the quarter because a lot of households were probably trying to pre-purchase some fuels or a lot of goods that they think that, inflation would impact in the upcoming quarters. So household spending was still very decent this quarter because of that. We do expect that, impact from the Middle East to show up from the second quarter of this year, though, as government, subsidizes the fuel costs. So a lot of that consumer spending would slow a little bit. Essential discretionary spending would certainly slow further in the upcoming quarters. And we do see that GDP might actually slow quite significantly to just 0.2% in the June quarter or 1.7% over the year. Remember, in the December quarter last year, we had 2.6% year-over-year growth. So that, I think, is quite a drastic decline in the pace of growth.
So you don't think we'll see a contraction in the June quarter?
I think so far, based on the data that we've seen out of consumer spending, from banks' transactions, or even from the labor market, there is a higher chance of a contraction in the upcoming months, especially if Hormuz doesn't open, but we don't see that coming just yet as of the second quarter. This is because I think our economy is still supported by an okay unemployment rate of 4.5%. Wages growth have still been quite okay, and a lot of households might actually get a bit of a wage rise from the July month, with yesterday's Fair Work Commission's decision as well.
Yeah, I'm just having a look through the ABS release and I can see that the per capita GDP in the quarter actually went backwards by 0.1% and the household savings ratio fell to 6.2% from 7%. What does that tell you about the state of the economy?
I think those are definitely the early signs showing us that the momentum in growth in the Australian economy has probably come to a halt. It's probably going to point downwards from here. In terms of GDP per capita, that's definitely not a good figure. But remember, we've had a lot of GDP per capita contractions before. It doesn't mean that the whole economy is going into a contraction. But it does show that the standard of living is going down and ultimately is tied to the fact that we've had quite minimal productivity growth in Australia. And in terms of savings rate, I think above 6% is actually still quite a high savings rate compared to the previous years. But I think the decline probably shows that maybe household budgets are starting to feel the pinch from basically, a tax. Think of the fuel price rises as a tax hikes on household budgets. They're definitely starting to feel that. And I think that also shows that households will be a lot more cautious in terms of splurging on major purchases over the coming months.
And of course, we had 2 interest rate rises in this quarter, but we've also had a follow-up interest rate increase in May. The RBA next meets in about 2 weeks' time. Are there any implications from today's data as to what the RBA will read from it and do at its June meeting?
I think in terms of economic data, so from the GDP data, from the latest labor market, as well as inflation data, all those are arguments for the RBA to actually pause a little bit just to see how the impacts are going from their 3 rate hikes. The RBA has stated before that it actually takes up to 6 to 12 months to actually see all the impacts from the rate hikes. So I think that it's probably not too wise for them to actually move rates too early, because I think the worst is yet to come in terms of economic data fallout from rate hikes as well as from the Middle East war. That being said, though, I think the RBA will have to sound pretty hawkish, given that we have quite a lot of wage pressures and cost pressures in the economy. We know that input costs for businesses are already going up in terms of fuel and energy costs. But I think that the input costs for services business, such as wages, are probably going up as well. And that is why the RBA has sounded quite hawkish over the recent days, especially in their communications about inflation expectations, about workers ask for wages rises, for example, and about their needs to temper people's expectations.
So just confirming, My Bui, you think there could be 2 more rate rises this year?
Yes, I think that's our view, given that, again, we've had quite a lot of wage pressures in the economy, and given that Hormuz is basically still not opened yet, I think we're yet to see the worst from inflation. We think that food inflation would probably go up, given that we've had a bit of fertilizer shortage. A lot of input costs for manufacturing around the globe are rising as well. So we do think that the RBA will move in August and in November. I think June is not our base case for now, but it's still a high chance.